Hi guys, welcome to another video. So in this video we are going to discuss about how to construct a team term sheet, because in the investment banking there's a term sheet is a very crucial concept, and without that there's a no deal in the startup or mature companies. So in the term sheet we have the table of content, and that have the number of items. Let's say this is the first one is the stock purchase agreement. So this is as was suggested by name. This is a agreement for the share purchase, and this is on the basis of the share, whatever the share the company is currently dealing in. So this is kind of the agreement we have. So this is kind of the information bureau of the number of the shares held by the number of the investors, with the details of investors, number of the stakeholder, and the value of the share. And also we have the diluted percentage of the investments offered by the investor to purchase the share stake in the company. So let's say take the example of Jean Lewis. It's a background note, and this is the owner and manager of the early stage growing companies. Often have the mixed views toward the institutional venture capital industry. So they welcome the money and management support, and they desperately need for the growth. So that's why they are looking for the funding, but fear the loss of control, and the various restrictions are typically placed on the company by the investment documents. So this is the hypothetical scenario of the investments as well. Like one side they will provide you the money, and other side they will control your stakes as well. So this is one thing. So the promoter of the company, Jean Lewis, is in the similar dilemma, and the Jean Lewis Inc. is a company which operate in the consumer product sector, and the promoter collectively hold the 100% stake in the company. The present capital structure of the firm is like promoter is ABC, runs the 100,000 shares, and the percentage shareholding is 100%. And the company being in the growth stage want to expand further, and therefore in the need of funds. A private equity agreed to provide the finance up to the extent of USD 375 million to acquire a stake of 16.6% post investment, which entailed him a total of 20% or 20,000 stakes in the company. So the post investment in the capital structure of the firm is promoter 100% or 100 of the shares of the stock, and the percentage holding is 100%, and the percentage holding post after that is 83.4%. And new shareholders are private equity, so it's 20,000 shares, and the 16.6% of the holding post holding of the share. Promoter existing stake comes down to 83.4% because of the entry of the new partner. To enter into a formal agreement, they formulate a term sheet taking into the consideration the needs of venture capitalist and the needs of the company. So this is one. And the term sheet is a share purchase agreement. So how to define that? A term sheet is a primarily non-binding document that lay out conditions under which investors agree to provide the financing. It's a summary of the terms the investor is prepared to accept, and designed to facilitate and provide a framework for the negotiations between the investors and the entrepreneurs. It outlined the key financials and the other terms of the proposal investments, and once agreed by all the parties, lawyers use the term sheet as a basis for drafting the investment documents, including the shareholders agreement and the article of association. So the provisions of the term sheets will include in these documents. And let's take example of company Jean Lewis Inc. looking for the private equity to fund their future operations. So this is the term sheet snapshot of the Jean Lewis. The memorandum of the terms represent only current thinking of the parties with respect to the certain of the major issues related to proposed private offerings, and it does not constitute a legal binding agreement, and the members of the term does not constitute to offer for the sale or soliciting of the offer to buy the security in any state. And the term sheet summarize the principles of the Series A. Let's say this is the Series A funding round, and is the financing of Jean Lewis Inc. What is the offering in that? So issuer is Jean Lewis Inc. and the securities are common stock. Valuation of company is USD 1880 million, and the amount of offering is USD 375 million. Number of the shares are 20,000 shares, and the price per share is 18.80. Investors are private equity and affiliate entities, and the capitalization is based on the number of different methods. So what is the general share purchase agreement? So shareholders and investors' rights are usually contain the investor protections, consent rights, right to board, the presentations, and non-competitive restrictions. And the articles of the association will include the rights attached to various share classes. The procedure for the issue and the transfer of shares and holding of shareholders in the board meetings are there. Some of the protective provisions in the shareholders agreement may be instead to contain the risk between the article of associations, etc. So decision include the one fourth or both of these documents may be jurisdiction specific based on the primary or company laws restriction. So these are something like that, and these associations are typically filed as a public document with the relevant registry, and other documents are there, so that will be kept confidential for the another reason. So this is all for the today's video. In the next video, we are going to discuss about the general share agreement and the terms of the agreement regarding the share letter. So let me take that, and next let's meet in the next video.